So there's an art to auditing, and I'm in business. I know how to, how to run a business, and I know what my concerns are. And when I hire a vendor or a service provider, I want to get something for my money. I don't want I don't want to hire new accountants and new auditors to fill out checklists. They're going to be completely bored with auditing right away. They're not going to be out in the field because we do everything from the office these days. But we encourage to go out in the field. We don't want to be disruptive, but nevertheless, it's fun to be actually at the site, see what's happening, and ask questions. And they can see you working. They see, oh, they're doing a lot of work, and we can get things done quicker because we're on site. We can get things done quicker and more efficiently because, yes, while we have assessed risk and internal controls and filled out the checklist, we are really checking. We are really verifying your assets, liabilities, revenues, and expenses. That's on the audit side. On the accounting side, the standards have gone topsy turvy. They've become more complex. They've become really a cost burden. There's the massive amount of footnote disclosures that overwhelm the reader. I'll give you a couple examples. One is this new revenue recognition. It's not that new, it's a few years old now. Revenue recognition, it's like this 5-step framework to see when the sale really occurs. You have to read the contract, and there's all these increments and milestones in the contract that will get you to the point where you can record a sale. Well, we all kind of know when you record the sale, when you ship the product, right? I mean, it's a little bit more difficult when you are building something for somebody and you have progress billings and that kind of thing. But to get distracted by this 5-step framework, which is relatively new, again, doesn't add a whole lot of validity to the results of the audit, but does add a lot of cost and time. Another area, which is really very recent, is that the accounting profession has been trying to put lease liabilities on the books forever. Years ago, what did we do? You paid rent, we deducted it as expense, right? Today, you look at your rent, you look at your lease, you look at your options, you add it all up, and you put on the balance sheet what they call a right of use asset. So if you're paying $100,000 in rent a year, and and the lease is for 5 years, you put on an asset on the books, $500,000 means I have an asset. I have a right to use this asset. I have to account for that. And people are scratching their head. Can I collect on that? Can you give me any money on that? Can I ever realize anything on that? No, you can't. But what's the count? It's double entry bookkeeping. So what's the offsetting entry? The other side of the entry? Well, it's a liability. I have to put $500,000 of liability that I owe to a landlord, which I used to just disclose in a note. Okay, now I have a liability on the books, and it totally upsets my debt to equity ratio. A banker first looking at it says, look at all those liabilities. You got to dig into the notes to figure out that it's kind of a fake liability. It's just your rent extrapolated out, not only for the initial period, but for the renewal periods. And then we have these methods to write off the rent, the right of use asset as an expense that becomes your rent. And when you pay your rent, it doesn't any longer go to rent. It goes to pay down this liability. It is so convoluted, that analysts of financial statements have figured ways around it. They have to cut through the weeds. They've employed programs, data analytic programs, to figure out what is really the quality of earnings here. What is the cash flow here? If I take out depreciation, if I take out right of use assets, and I take out this revenue recognition stuff, and what have you, if I take out deferred taxes, which is not even a tax expense, what did you really make? And my concern is that we want the reader of the financial statement to get an immediate impression of how that company is doing. And I have to say, our footnote disclosures far exceed, in terms of pages, far exceed how much our financial statements, how many pages our financial statements consume. And so I think it just becomes it just becomes unwieldy. So, as I say, our accounting firm knows this. We are sympathetic to it. Okay, we know what a good audit entails. We are aware that if I'm looking at a general ledger and I'm scrolling through the whole ledger, I know what accounts to test and what amount to test to. You know, we have materiality thresholds and what have you, and I'll get a good idea. You know, in a small sample, you kind of get an idea of how things are going. You can. I used to be in politics, and I was always, it was in a small town in Connecticut, and I would always go to the polls, and they would read the machine vote, the first machine vote, out of like 12 machines. Whoever was winning on that first machine vote won, ultimately. And so accounting is like that, auditing is like that. You know, you start taking a sample, a robust sample, not a sample that is so meaningless and so trivial because you've done your risk and your internal control assessments that you figured out a way not to have to do that stuff. But we take a meaningful sample of actually testing transactions, walking them through the whole process. We get an idea, okay, something's amiss here. And then if we have to, we'll audit more. But if we don't, we leave it alone. So I think between the GAAP overload and which is generally accepted accounting principles, and the auditing standards overload, you know, the accounting profession is working its way into, like, as I said before, a very mechanistic view of things, and ignoring, you know, what is at the core of this engagement. What did the company really make? And I think our accounting firm offers that. It doesn't lose sight of that.